Hi there, my name is John Stevenson, the Guaranteed Retirement Guy. Today we're going to be talking about whether or not annuities or bonds are the best. So this can be subjective. Of course, everyone has their opinion. Some people hate annuities, some people hate bonds, and for good reason for both of them, really. It just depends on what you are looking for. If you're looking for maximum growth, usually the stock market's the best way to go. But if you don't want the risk, then there are some very, very attractive yields coming from bonds as well as annuities. So you might be thinking, well, which one should I pick? Okay, I have people that will kind of set up a bond ladder or even an annuity ladder. And sometimes one works better than the other, just depending on your current circumstance. So I'm going to share my screen and I want to show you actually something that I saw today with bond yields. All right, so you'll see bond yields here. 10-year treasury yield nears 4.5% again. How does this impact things? Well, if you own a bond right now, a current bond, and we have these new yields, these new bonds offering 4.5, and maybe yours only offers 4, what happened to the value of your bond? You're right, it went down, unfortunately. And so a lot of times when people put money into bonds, they think, oh yeah, I'm protecting myself against risk because I'm not in equities. The problem is, if there are newer bonds issued with higher yields, then they're going to be more attractive, which means the value of your current bond is going to go down. And if you sell it to get out of your position, you're going to realize a loss, which will then further erode the current past yields that you got from that old bond. And so it could be a downward spiral, and people will get very, very frustrated with that. And that's why they reach out to me when they're looking at fixed annuities, because fixed annuities right now are paying a percentage point above that, 5.5%. And so you can get more income if that's what you're looking for as far as interest. You can also grow your money tax deferred, even with non-qualified money, which is pretty attractive as well. So there's always interest rate risk, right? So if interest rates go sky high, even after buying an annuity, you're going to have other annuities that are being offered at higher rates than maybe the current one that you have right now. The nice thing is that your current annuity will continue to pay out what it's paying out. It's not going to reduce the amount that pays out. Now, if you were to surrender that, you'll have an MVA charge. MVA stands for market value adjustment. And that basically reflects the interest rate environment because the insurance company realizes a loss when they have to get out of that particular position early. So if interest rates go up, the value of the underlying investment backing your MYGA annuity is reduced. And so because of that, it will do a negative effect on your surrender value. Now, the opposite is true as well. If interest rates go way down, then the value of the investment, the underlying bond that is backing your MYGA contract, will go up, which means if you actually get out of that, you're going to have a positive adjustment on your surrender charge, which is pretty nice. So it really just depends on what you're looking for. If you're looking for a bond that gives you maybe a lower return, but gives you more liquidity, maybe you just want to get out, you can do that. But you have to realize if interest rates do rise and you do get out, you're still going to realize a loss, okay? Very comparable to a surrender charge that you might realize from a MYGA contract. So you might be asking, well, okay, so which one do I choose? How do I know which is best? Well, I'll show you my screen again and we'll look at 4.5. Okay, 4.5 is pretty good. Then I'll go over here and say, well, what are current annuity rates right now for MYGAs, okay? And I'll show you all the rates here. Okay, there are, and I'm just throwing in 500,000, just hypothetical as far as looking at rates. There are some MYGAs that will pay less if you put less premium in, like less than 250 or even less than 100,000. Usually anything over 100,000, you get the highest rate. So anything below that, sometimes it's a little bit less. Anyway, so if we look at these rates, and this is showing all across the board. You can see 7-year, 5-year, 6-year, and the rates are pretty good. They're really good. Really, really good. So let's say I want to say, well, how long can I lock in? I don't know. Let's say we'll just say do 10 years. 10 years. What's the best 10-year options? So if we look at that, we see Equitrust is offering 5.5. And they allow interest-only withdrawals. Anything above that is subject to surrender charges. You got Ocean View. They actually give up to 10%, but they don't let you take that until after the first year. So and it looks like the rest were Exonic, Clear Spring, another Exonic, and then, American National, which we know as Anico, they'll give you 10% right from the get-go, right from the beginning. But there is a little sacrifice of rate. You're only getting 5.3 versus a 5.5. That's not a huge difference, but it's still a difference. So there you go. So I can pull that up. In fact, I'll pull it up right now so you can see what it looks like. All right. So if we look at earnings, you can see 26,500 because you're doing 5.3 multiplied by $500,000. Okay. If you take that out every year and you just live off the interest, you can do that. And at the end of 10 years, then you've got 500 grand left. But if you let it compound, it's going to compound pretty significantly. $338,000 of earnings. Okay, and if you're putting non-qualified money, which is just cash or brokerage money, something that's not a 401k, not an IRA, it's still going to be tax deferred. It'll still compound. Okay, you can't do that with just a brokerage account and bonds. Okay, that's the nice thing about this is if you want to compound those earnings, those payouts, every month or every year, however often you take them, you can do that with a MYGA. Okay. So it's just kind of an advantage that you have as far as having tax-deferred growth in an annuity contract. You also have certain protections, depending on the state, against liens and creditors. So a lot of good things about annuity contracts, okay? More protection for your money. And as you can see, even more interest earned. 4.5% is not bad from the Treasury, but why not get 5.3? Okay? Why not get higher than? You can see Equitrust is 5.5. So I do a lot of Equitrust. And I have people taking systematic withdrawals off those every single month. So you want to do that. It's $27,500 per year. Okay, guaranteed. You take that over 10 years, you're going to take that all out and then take your 500 grand back and put it somewhere else, or roll it over into another annuity contract. Or you can just let the thing compound and the guaranteed ending balance is $854,000. That's really, really good. Okay, so I favor annuities because of the safety. Treasuries are also safe, as we know, but you could earn more with annuity contracts. And so I like being able to earn more for my money and still have relative safety behind it. And so even with some B++, like this one we're looking at, Equitrust, it is B++. You could always spread it out, maybe put 250 in one and 250 in another, depending on what your state insured amount is. But you don't have to. Equitrust is also, they were rated A from Fitch and from Standard & Poor's. AM Best is the only one that hasn't rated them an A yet. So when you have positive momentum from a company like that, usually you can trust. When you got momentum like that, that's probably pointing to higher ratings later on, even from AM Best. So anyways, that's what I would recommend. If you're looking for highest growth and you're looking for tax deferral, then look at an annuity. Okay, look at a MYGA. MYGA just stands for multi-year guaranteed annuity. They're the annuities world's version of a CD. Okay, except CDs, you're taxed every year on the earnings. With MYGAs, you're not. So pretty nice. There definitely is some upside to choosing an annuity over something else. So anyways, I just want to talk about that because it's interesting. You can just buy treasuries. You can buy corporate bonds, whatever you want to buy, and there's nothing wrong with that. You just have to realize you have interest rate risk, okay? If you do have interest rates rise, the value of your underlying investment, whatever you purchase, is going to go down. And if you decide to sell and get out, okay, your overall yield up to that point is going to be reduced by whatever the losses are from you selling that position. So anyways, just basic math, but it's good to know. And if you're looking for much higher growth than a treasury bond, you've got them in annuities and you can do it rather safely. So anyways, hope that helps. If you want to book a call and you were thinking, hey, I'd like to purchase a MYGA for myself, or maybe you're looking to purchase a fixed index annuity with an income rider because you want lifetime income. Those are very, very, very high right now just because of rates. Then book a call. There's a link below this video. It goes directly to my calendar. And you can also go to my website, johnstevenson.com, and you'll be able to actually search the top MYGA options as well as income riders if you're looking for guaranteed lifetime income. And so then you can do your own research. And then if you feel comfortable, you can reach out to me after that. So anyways, happy to help and look forward to working with you. I hope this video has been helpful. Hopefully it's been valuable. I really appreciate you watching. And I hope that if you do like the video, you'll click the like button, subscribe, share, comment below. If you got questions, I'll be happy to answer them. And we'll see you next time.